You see a house on the market, and as a new home buyer, they're coming to say, hey, well, this house is offering 3.75% assumable mortgage, right? And today we have Bob back with us, and today we're going to be focusing on the VA loan assumption. I know a lot of people in today's market have, the interest rates being a little bit higher than we have been in the early 2020s and 2021s, where rates were in the threes and fours and those 30, 50-year low rates. And now we're going to, hey, can we take advantage of those low rates in the past? And we'll touch on too the divorce aspect here at the back end of this video. If you're interested in that, we'll touch on that. But for the new home buyers that are out there looking today to try to take advantage of these 3.7 or 3.25 interest rates that some home buyers got, and now they're saying, hey, I got a VA loan, and VA loans are assumable. What do you have to say to those people, Bob? And does that make sense for them to try to like make that offer and buy that home versus just go out and get a new loan themselves today?
Well, Scotty, great to be back with the Gifford Group. Always appreciate the opportunity to share quickly with people. But some of the advertising about this home is VA assumable is marketing. And it's good marketing because people immediately think, oh, if I could get a 3.5% interest rate and assume it, that's fantastic. The challenge is most VA buyers don't want a down payment. And if you assume the loan and somebody has a house that, let's say they paid $350,000 for it 6 years ago, now they're selling it for 475 or 500, let's just say 500, and they owe 340. If you were able to qualify and assume that VA mortgage at 340, you got to bring 160,000 to close to be able to assume that loan, because they're not going to let you buy it at the assumption level that they want appreciation in their house, just like you would. When people find that out, they go, oh, well, I don't have $160,000 to do that. So it wipes it out. So be careful that you don't fall for, I see a lot of people using that as a marketing gimmick.
The biggest point is like you're going to have to make up that down payment wise between the sales price and the purchase price, or what the current loan is and what you're buying the property for. So that could be $100,000 or 50,000 or $200,000, right? So that could be huge money you got to come up with out of pocket to make up that difference. And then you got to get qualified for that rate too, right? So it's not just hey, I can just take it over. You're going to have to get qualified with the current lender that has that current mortgage, right?
If you go back 15 years, they used to have assumable loans, and some people have heard of it. Some of their parents have done those. Actually, I'm old enough that the first house we had was an FHA home that was assumable. The person that assumed our note couldn't qualify for the mortgage because he had a bankruptcy, and so he was able to assume ours. That was decades ago. And after Dodd-Frank passed in 2010, the Wall Street Reform Act, they created a word called qualified mortgages. So anybody that does an assumption, the lender has to qualify that person to make sure they are qualified. In my example, when I had somebody take our first house with a BK, they wouldn't have qualified. And you have to credit qualify and everything else, and to prove that you can make those payments. So an assumption today takes about 6 months, and I see like 1 in 30 go through. Most of them don't, and it's very, very, you have to have a lot of patience, and then you're let down when they say, I'm sorry, you don't qualify. So it's much easier to get your new loan, go in there, and when interest rates drop, refinance it.
You see a house on the market, and as a new home buyer, they're coming to say, hey, well, this house is offering 3.75% assumable mortgage, right? And you go in there and then you talk to someone that's educated, and you go, well, actually, you got to make up that $100,000 down payment. So you're going to need like $115,000 to buy this house. And yeah, you'll get that rate. But realistically, it'd be better to go, hey, let's go use my VA loan benefit. I can buy it with zero down payment. I just got to pay some closing costs. Maybe I can get that seller to pay those closing costs for me. And then in the future, I can use the EARL, which we talked about in our last video, which I'll link to below, where we talked about, why it's a great time to maybe use the VA loan benefit now and then refinance in the future. So that way they can still get that home they want today. And then they can get that lower interest rate in the future if rates do, or if and when they do drop in the future, right?
Absolutely. on assumptions. A lot of people that are going through it, and I know what the Gifford Group does a lot of divorce lending and divorce real estate. A lot of people think, gee, I want to assume. And if you're going through a divorce and there's equity in your home and you want the spouse that wants to keep the house wants to assume the loan, they've got to come up with another way to pay that equity out, because you cannot do any divorce, OLT buyout or divorce buyout in an assuming loan at all. VA, conventional, and it doesn't exist. You can't get a penny back in the state of Texas out of an assumption, and you sure can't pay an ex-spouse tens of thousands or more in a buyout.
Yeah, that's a question that we get almost on a weekly basis here at the Gifford Group. Because that's kind of our specialty, is helping people that are going through divorce, and they always want to know, well, what can I do with the house, and can I just keep the current mortgage, right? And it's like, well, yeah, but your ex probably wants some of that equity that has built up over the last X number of years of your marriage, right? And it's like, and the first thing we go, well, you could, assumption is an option, but it's likely not a great option unless you got a boatload of cash sitting somewhere, or a lot of money in a 401k that you're willing to part with, and then they're willing to do with the repercussions of whatever tax implications that has to be. Where if you just, what we usually end up suggesting is kind of doing a buyout of their spouse. And with the VAs, they'll be limited to 90% loan to value on the refinance. Where, you know, a traditional OLT lien, we could maybe tap up to 95% of the home's equity, right? Or so we could tap a little more if we want. But a lot of times we might be in the 80% or 85%, depending on their situation. And there's a lot of variables that go into that. But we always look at the best course of action for each client and say, what loan makes the best sense? Where are you at? And we kind of walk them through that situation. But that's a question we get all the time is, well, can I just assume the current mortgage from my spouse? And of the probably 300 plus conversations we've had with clients, I've had one that was able to do a VA loan assumption. And he was the veteran, he had the money, and he had the cash to buy her out, right? And so he was able to keep his low interest rate on that home. But that's one out of 300 plus conversations, right? Or 300 plus clients we've talked to. So,
Well, and one thing I'd add to that, I've seen well over 100 times people have said, well, I'm divorced. My ex-spouse got the house and I didn't get off the mortgage, and he was in a car wreck or he got sick and he missed payments. And then the house, it ruins that person's credit. And when they think, oh, he or she's going to make the payment always on time. If you're on that mortgage, you're still responsible for that house, even if you don't live in it, even if the divorce decree says it was awarded to the spouse, because you signed a note, you signed a contract, a mortgage note that said, I will be responsible to pay that mortgage back. So if an ex-spouse doesn't pay it, you've got to pay it. And I've seen people that didn't even know they had a foreclosure on their record until they find out their ex-spouse didn't pay when they were supposed to.
yeah, we've gotten a lot of those calls too, saying, well, what can I do? My spouse isn't paying the mortgage anymore, and I'm the one that's on it. And it's like, you agreed to do that, let them stay there. Or you agreed that you didn't, you kind of settled this house thing and you left yourself on the mortgage. And we don't ever recommend that at the Gifford Group, because it just leads to too many problems down the road. If you're in a situation where you're divorcing, we can happily, you can schedule a call with us and we can talk to you about that, what your options are personally. But we just never an option we recommend. And we always want to kind of divide as much things as possible. Obviously, if you have kids, you can't divide the baby in those, but all the other things you need to be kind of splitting ways with. So,
Biggest thing we covered is you got to come up with the cash between what the house is on the market for and what the assumable loan amount is. And most people are shocked when you tell them that.
yeah. And I think that's just, once we start digging into the situations, we find out it's usually more expensive to do something than we think it would be. So, but the VA is a great loan program for those people that are new home buyers, and just,
Absolutely. The best one out there.
I'll link down to our blog below too about the VA and all the benefits of that. And I thank it so much for always watching. We're here to bring you real life experience to all your real estate needs. Thanks.
Thank you, Scotty.